Good afternoon. Today we are going to be looking at the May-June 2021 paper. And looking at the May-June 2021 paper, question number 1.1.1, they give us that information. So they give us the return on the market portfolio, they give us the risk rate of return, and they say calculate the expected return on investment with the following betas as well, right? So for question 1.1, it would mean for question 1.1.1, we know using the capital asset pricing model, the required rate of return is given as the risk rate of return plus beta, market return minus the risk-free rate of return. And if you look at this equation, the market return minus the risk rate of return gives you the market risk premium. Then if you include the beta in it, you have the asset risk premium. So you need to check to see exactly what information is given on the question for you to be able to answer the question as well. So for part A of the question, they ask us to calculate the expected return given that the beta is equal to 0.3. So to get the expected return, we're going to say, we're given that the risk rate of return is 5 plus the beta of 0.3 in brackets. The market return is 13.5 minus the risk rate of return, which is equal to 5%. So given this information, how much do we get as the expected return?
7.55%.
So 7.55%. On part B of the question, they also ask us to calculate the expected return given that the beta is equal to 1, isn't it? So your 5 plus 1 in brackets, 13.5 minus 5. How much do you get as your expected return?
13.5.
13.5.
Yes.
So it will be equal to 13.5%. Then if you go to part C of the question, your expected return is going to be equal to, we're assuming that the beta is equal to 1.5. So it's going to be 5 plus 1.5 in brackets, 13.5 minus 5. So in this case, how much would you get as your expected return?
17.75.
17.75.
Yes.
Are we on the same page, or are we getting these amounts? Any questions? Now, remember, they also say, they ask us to calculate the expected return and indicate whether the investment has more or less systematic risk than the market portfolio for each of the respective betas, right? So by default, we know the beta of the market is always equal to 1. So by default, no matter what happens, the assumption is the beta of the market is equal to 1. So which means if this, in scenario A, if the beta is 0.5, it means that the asset is going to be having what? Less systematic risk than the market, isn't it? And if the beta is 1, it would mean the asset would be having the same systematic risk as the market. And if the beta is 1.5, it means it has more systematic risk than what? Than the market. So that's basically the second part of how you would answer the second part as well. Are we on the same page? Are we on the same page?
Yes, but is it in the textbook? Does it say that the market risk is 1, assumed to be 1? Because I'm hearing this for the first time because I didn't know how to answer that.
They don't explicitly mention it because they are assuming that you should be knowing it by default. So by default, you should know that no matter what happens, the beta of the market is always equal to 1 all the time by default.
Okay, thanks.
Okay.
This one is explain the B part of it. You said the first one is less systematic risk, and then B is
B. It has a beta
Yes.
of 1. So if it has a beta of 1, and we know that by default the market has a beta of 1, it means scenario B, the asset has the same systematic risk as the market.
Yes,
so
the
it
market.
has systematic risk as the market.
Okay, thank you so much.
Okay. Are there any other questions? Okay, we move on. On the next question, so from the given information, they are telling us that they are giving us the equity of, they say the bank's equity is 3.5% of the assets. Then they also tell us that there is a mean of 0.5% of the assets and a standard deviation, which is equal to 1.8% of the assets. So they ask us, what is the probability that the bank will have a positive equity at the end of the year, right? So which means the equity need, so in this case, the equity need is going to be, is given as, so the equity need, is given as the mean, so the equity need is given as the mean minus your Z value multiplied by the standard deviation. So the equity need is equals to your mean or your mu minus the Z value multiplied by the standard deviation. So in this case, we are given that we're given the equity need, because remember they say the equity has to be 3.5% of the assets. We are given the mean, which is equal to 0.5% of the assets. We are given the standard deviation, which is equals to 1.8% of the assets. So in this case, we need to solve for Z, for the Z value, which is your, we need to solve for the Z value. So in this case, to solve for the Z value, we're going to say the equity need is equal to 3.5% of the assets. So it's equal to 3.5% of the assets is equal to the mean, which is 0.5, minus the Z value, which is what we're looking for, multiplied by the standard deviation, which is given as 1.8% of the assets. So given this information, we need to solve for the Z value, because the Z value will give us the associated what probability there. So in this case, if you take 0.5 to this side of the equation, it would mean 3.5 minus 0 is equals to minus Z multiplied by 1.8. So 3.5 minus 0, it will be equal to minus Z multiplied by 1.8. Sorry, 3.5 minus 0.5, it will be minus Z multiplied by 1.8. Then from here, it basically means that you're going to divide this side by minus 1.8 and this side by minus 1.8. So if you do the calculation, how much do you get as the associated Z value?
2.222.
Please redo the calculation. How much do you get?
It's 1,66 minus.
It's going to be minus 1.67, right? So it will be minus 1.67. Now, if it's minus 1.67, remember, we are looking for the probability that the bank will have a positive equity at the end of the year, right? So which means that if you're looking for the probability that the bank will have a positive equity at the end of the year, it basically means that in this case, your Z is assumed to be a positive value. So in this case, it would mean the Z is always going to be assumed to be a positive value. So which means on our normal distribution table, we are going to be looking for the value corresponding to a Z value of what? 1.67. So on our normal distribution table, we are going to be looking for a value which corresponds to a Z value of what? 1.67. So if you go to the normal distribution table, you will see that so on the normal distribution table, remember if you are given 1.67, on the first column, you are going to be looking for the value of 1.6. Then on the first row, look for a value with a 7 in it. So on the first column, you look for 1.6. And on the first row, you look for a value with a 7 on it. So if you check on your normal distribution table, you are going to say, based on the normal distribution table, a Z value of 1.6 is here, where you have 1.6 here, and you have a 0.07 there as well. So a Z value of 1.6, you have 1.6 here, and you have 0.07 there, which gives you 1.6. So which means the corresponding value in your table the corresponding value in your table this corresponding value in a table would be equal to 0.9525. So the corresponding value in your table will be equal to 0.9525. So it's going to give you 0.9525. So which means if you get 0.9525, if you multiply that by 100, it would mean, so if you multiply that by 100, it would mean the bank has a 95.25% probability of having a positive equity. So in this case, it means the bank has a 95.25% probability of having a positive equity. So therefore, the bank has a 95.25% probability of having a positive equity. Are we on the same page? Can you move on? On the next question, they say, explain the two broad risk management strategies used by financial institutions. So they ask us to explain the two broad risk management strategies used by financial institutions. So to answer this question, if you check in the textbook,
Page 18.
yeah, if you check in the textbook on page 18, so they say there are two broad risk management strategies open to a financial institution. One approach is to identify risks by one by one and handle each other separately. This is sometimes referred to as risk decomposition. The other is to reduce risk by being well diversified. So this is sometimes referred to as risk aggregation. So both approaches are typically used by financial institutions. So you get your answer there from page 18 of the textbook. Can we move on?
Yes.
On question 1.2, they say, what features of policies written by property casualty insurance company is responsible for most risk? And to answer that question, if you check on the in the textbook on risk arising from catastrophes,
Page 47.
Risk arising from catastrophes. So,
Mhm. 57, section 3.5.
risk arising from catastrophes. Where do we find that?
Yes, page 57.
Okay. So if you check on page 57, so if you check on page 58, If you check on page 58, they tell us that, remember, when it comes to liability insurance, they say liability insurance, like catastrophe insurance, gives rise to total payouts that vary from year to year and are difficult to predict. For example, claims arising from asbestos-related damage to workers' health have proved to be very expensive for insurance companies in the US. A feature of liability insurance is what is known as long-tail risk. So this is the possibility of claims being made several years after the insured period is over. So which means, going back to the question where they say, what feature of policies written by property or casualty insurance company is responsible for the most risk? So in this case, the feature of liability insurance, which is what we discussed here, which is the long tail risk, is basically the one that is responsible for the most risk. I need to cross-check something here. If you check on page 58, they say on section 3.5, on section 3.5, on page 58, on section 3.5, they say typically property casualty policies are renewed from year to year, and the insurance company will change the premium if its assessment of the expected payout changes. So because property casualty insurance companies get involved in many different types of insurance, there is some natural risk diversification. Also, for some risks, the law of large numbers apply. For example, if an insurance company has written policies protecting 250,000 homeowners against losses from theft and fire damage, the expected payout can be predicted reasonably accurately. So this is because the policies provide protection against large number of independent events. Then if you go to the next paragraph, they also say property damage arising from natural disasters such as hurricanes gives rise to payouts for insurance companies that are much less easy to predict. For example, Hurricane Katrina and in the US, for example, Hurricane Katrina in the US has proven to be very expensive. So these are termed to be catastrophic events. So the problem with them is that the claims made by the different policyholders are not independent. So either a hurricane happens in 1 year and the insurance company is to deal with the large numbers of claims for hurricane-related damage, or there is no hurricane in the year and therefore no claims are made. So most large insurers have models based on the geographical and seismographical and meteorological information to estimate the probabilities of catastrophes and the losses resulting from as well. So this provides the basis of setting premiums, but does not alter the all or nothing nature of these risk insurance companies. So liability insurance, like catastrophe insurance, give rise to total payouts that vary from year to year and are difficult to predict. So for example, claims arising from asbestos damage to workers' health have proved to be very expensive for insurance companies in the US. So a feature of liability insurance is what is known as the long tail risk. So this is the probability of claims being made several years after the insured period is over as well. So if you look at now the property of, remember the question was saying, what feature of policies written by the property casualty insurance is responsible for the most risk? So you will see that the most, because of the unpredictability of the payouts, especially when it comes to due to catastrophic risks and also due to long tail risks as well. So these are the two that results in, those are the two features that can result in what situations where the most risks are going to be coming from as well. So in most cases, because for example, if it's just a normal household insurance, it basically means that because of the law of large numbers, they can be able to mitigate that risk. But now most of the risks which are coming from catastrophic risks and also from the long tail risks are the two features that which can result in what most risk are emanating from as well. So the most risk could be coming from the risk of catastrophic risks and long tail risk as well. And the catastrophic risk is going to be from the property insurance side, from the property side, and from the liability side. This is where you find the long tail risk as well. So you get your answer from page 57 going on to 58 of the textbook. Are there any questions there?
So yes, Rhinos. So for this one, since they're saying the property casualty insurance, which one are we taking, the long tail risk or both?
Both of them. Both of them. So you now need to say from the property risk, from the property side, it would be the risk of catastrophic losses, like for example, catastrophic risks. And from the liability insurance side, it would be the issue of the long tail risk as well. So these are the two features which make where most risks basically would be emanating from.
Okay, thank you.
All right. Are there any other questions? Moving on to question 1.2.2, they give us that information. So they give us two scenarios. The first scenario is where the share price ends up being $30. And the second scenario is where the share price ends up being $23. And then they say explain the difference between the two alternative arrangements as well. So which means looking at this, so which means we are for both scenarios, we are assessing whether we're assessing to see exactly what would be the better in the given two scenarios as well. So for scenario one, if we consider using the firm commitment method, so if we consider going the firm commitment route, it would mean the profit would be equal to, remember, at the end of the period, we are saying that the share price ends up being $30. And with the firm commitment arrangement, we are committing to buy these shares at $25 per share, right? And we are dealing with what? 12 million shares. So the anticipated profit in this case is going to be $30 minus $25 multiplied by 12 million shares. So in this case, how much profit would we be anticipating?
60 million. Yeah, 60.
60 million.
Yes.
So we'll be anticipating a profit of 60 million. Then if we choose the best efforts arrangement,
Rhino,
yes,
can I ask the question? The question on 122 says that the company where it under firm commitment where it buys the shares for $25 per share, and under the best efforts arrangement where it charges a fee of 30 cents. But I see here is your 30 is a whole number, not a sub a point 30.
Now they are going to be charging a fee of 30 cents, right? But that's for the other arrangement. For the firm commitment arrangement, we're buying the share for $25. Now we need to find out exactly. So we're basically saying we are committing to buy from you the shares for $25. Then when we buy the shares from you for $25, we are the ones who are going to take the risk and sell these shares in the market after buying the shares from you, right? So if we now if the share price ends up being $30, because if you check on the right on line number 2 from the bottom of the question there, that's when they give us the different the given scenarios to say if in the first scenario, if the share price ends up being $30, what is better for us? Are we going to make a profit? If the share price ends up being $23, are we going to make a profit as well?
Okay, I see.
So in the first scenario, where the share price ends up being $30, we're trying to find out exactly, so what would be better off for us? Are we better off going the firm commitment route, or are we better off going the best efforts arrangement?
Yeah.
Because if we go the best efforts arrangement, the fees that are going to be able to charge there is going to be equal to, we are charging fees of 30 cents per share for the arrangement, isn't it? So we're going to be charging a fee of 30 cents per share, right? So which means if we charge a fee of 30 cents per share, it's going to be $0.3 multiplied by 12 million shares. So this will tell us exactly how much in fees we're going to be able to get and how much should we earn in fees there.
3.6 million.
3 point?
0.6.
So it will be 3.6 million. So what do we see here? If the share price ends up being $30, we are actually better off going the firm commitment route, isn't it? Because we'll earn a profit of 60 million instead of earning only 3.6 million. Are we on the same page? But now, for scenario two, if we choose to go the firm commitment route, our profit is going to be equal to, remember for scenario two, at the end of the period, the price ends up being $23, isn't it? So in this case, it's going to be $23 minus the price that we're buying these shares for, which is $25 times 12 million shares. And how much do we get?
It's a loss of 2.4 million.
So suffer a loss of 2.4 million. But if we go the best efforts route,
3.6.
our fees are going to be the same. 0.3 multiplied by 12 million shares, which is equal to 3.6 million. So what do we see about the two alternative arrangements? The best efforts arrangement guarantees us a fee, isn't it? The best efforts arrangement guarantees us a fee, and the firm commitment arrangement can either make us a huge amount of profit, or it can result in us suffering what? A loss as well.
Sorry, Reynolds.
Mm-hmm.
With the firm commitment, isn't it 24 million loss? Because you got 2 times 12 million. So it's negative
Yeah,
2 times.
it will be 24 million. Sorry, I was
2.4.
just checking. Let me just check on my answer. Yeah, it will be a loss of 24 million. It's a loss of 24 million here. So here, it's a loss of 24 million. So do you see that the firm commitment arrangement is more riskier than the best efforts arrangement? Because with the best efforts arrangement, you are guaranteed a fee that you're going to be earning. But with the firm commitment arrangement, it's either you make a lot of profit, or you can make a lot of what? Suffer a lot of what? In losses as well. Are we on the same page?
Brenos, with the firm commitment, you only make money if the share price goes up. The minute the share price drops, with the firm commitment, it's only profitable if the share price goes up.
Yes, it's profitable if the share price goes higher than the price you agreed to buy the shares from the issuer.
Yes, so that's the only that's a requirement to make for it to be profitable. If it goes down, then you're definitely making a loss.
Yes.
Okay.
Can we move on? On the next question, they say, what is the main reason for regulating banks? On question 1.2.3, they say, give 3 examples of regulatory requirements that affect mutual funds. So they ask us to give 3 examples of regulatory requirements that affect mutual funds. If you check in the textbook, this page.
I think it's page 84.
On which page?
84.
The mutual fund must disclose their investment policies. Yeah, on page 80, if you check on page 84, on page 84, I have the answers, but I forgot to put references on where I got the answers from. If you check on page 84, they say, they say hedge funds are different from mutual funds in that they are subject to very little regulation. This is because they accept funds only from financially sophisticated individuals and organizations. So examples of regulations that affect mutual funds are the requirements that the first one being the shares be redeemed at any time, the net asset value be calculated daily, the investment policies be disclosed, and also the use of leverage be limited as well. So then they also say hedge funds are largely free from these types of regulations. So your answer there, you get it on page 84 of the textbook. Moving on to question 1.3. They say, what is the main reason for regulating banks? If you check on page 347, if you go to page 347, on page 347, they say the main purpose of bank regulation is to ensure that a bank keeps enough capital for the risk it takes. So the main reason for regulating banks is to ensure that the bank keeps enough capital for the risks it takes. So you get your answer from page 347 of the textbook. Then on the next question, they say, discuss the 4 key principles of the Pillar 2 under Basel II, and you get your answer from page 370 of the textbook. If you look at page 370 of the textbook, so just to give an overview, remember we said when you look at Basel II, if you check on page, on section 15.8, on section 15.8, they say the credit risk under Basel II are specified under 3 approaches: the standardized approach, the foundation internal rating based approach, and the IRB, the advanced IRB approach there as well. So based on that, if you go to page 370, this is where they now look at the different pillars, where we said that the first pillar looks at so if you check on page 359, if you check on page 359, this is where they discuss the Basel II, where they say the implementation of the rules began in 2007 after further QIS meetings. Then they also say the Basel II is based on 3 pillars: the minimum capital requirements. It also addresses the supervisory review and also the market discipline. And this is where they say if you look at, they say in Pillar 1, the minimum capital requirement for credit risk is the banking book, is in the banking book, is calculated in the new way that reflects the credit risk of counterparties, right? Then they give us how it's calculated there. Then they also look at the credit risk under Basel II. And then they say it's calculated by looking at the 3 approaches. And if you check on page 370, this is where we look at the second pillar. And on the second pillar, they look at operational risk under Basel II as well, where they say when you look at operational risk under so on page on section 50.9, they're basically looking at operational risk under Basel II. Then if you check on page 370, this is where they now look at the second pillar, which looks at what? Supervisory review. And under that section, they say Basel II of the Pillar 2 of Basel II is concerned with the supervisory review process. So 4 key principles of supervisory review are specified. The first one being banks should have a process of assessing their overall capital adequacy in relation to their risk profile and a strategy for maintaining their capital levels. Then the second one is supervisors should review and evaluate banks' internal capital adequacy assessment and strategies, as well as their ability to monitor and ensure compliance with the regulatory capital ratios. So supervisors should take appropriate supervisory action if they are not satisfied with the result of this process. Then they also say supervisors should expect banks to operate above the minimum regulatory capital and should have the ability to require banks to hold capital in excess of this minimum. Then supervisors should seek to intervene at any stage to prevent capital from falling below the minimum levels required to support the risks, credit risks of what? A particular bank, and should require rapid remedial action to, if capital is not maintained or restored to the minimum capital amount as well. So this is basically, these are the 4 key principles under supervisory review under Basel II. Is there any question regarding this? On the next question, they say one of the components of Basel III is capital definition and requirements under Basel III. What are the capital requirements for banks? And if you check in the textbook,
page 381 to 80.
there's a 2.5 and 3. There's a 2.5 and 3. So we discuss Basel 2.5. Now after that we get Basel III. If you check on page 382, if you check on page 382, if you check on page 382, so remember the question says, one of the components of Basel III is capital definition and requirements. So under Basel III, what are the capital requirements for banks? So the capital requirements for banks, they say under Basel III, total banks capital consists of tier 1 equity capital and additional tier 1 capital and tier 2 equity capital, and there's no tier 3. And then they say tier 1 equity capital includes the share capital, retained earnings, but does not include goodwill or deferred tax assets. So it must be adjusted downward to reflect defined benefit pension plan deficits, but not adjust upward to reflect defined benefit plan what assets as well. Then they also say additional tier 1 category consists of items such as cumulative preferred stock that were previously under tier 1 but not common equity. Then tier 2 capital includes debt that is subordinated to depositors with an original maturity of what? Of 5 years. So these are the capital requirements as well. So which means in this case, they are basically also stated here under this way. They say the capital requirements are as follows. For tier 1, the capital must be at least 4.5% of the risk-weighted assets at all times. And then total tier 1 capital must be 6% of the risk-weighted assets at all times. And then the total capital must be at least 8% of the risk-weighted assets at what? At all times. So this is basically, these are the capital requirements under Basel III. Are there any questions? On question 1.3.4, they say explain the concept of residual risk add-on and indicate how this is calculated in terms of the Basel committee requirements. And if you check in the textbook, on page 421 of the textbook, if you check on page 421 of the textbook, so on page 421 of the textbook, they talk about the residual risk add-on, and here they say, the residual risk add-on considers risk that cannot be handled by the delta, vega, or the curvature approach described earlier. So it includes exotic options when they cannot be considered as linear combination of plain vanilla options. So the add-on is calculated by multiplying the notional amount of the transaction by a risk weight that is specified by the Basel committee. So in this case, the exotic option, in the case of exotic option, the risk weight is going to be 1%. So your answer would be, it considers the risk that cannot be handled by the delta, the vega, or the curvature approach. So it is calculated by multiplying the notional amount of the transaction by a risk weight that is specified by the Basel Committee. So you get your answer on page 421 of the textbook. Can we move on to question 2? All right, can we take a few minutes break until 3:30? Then at 3:30, we move on to question 2. So can you take a few minutes break until 3:30? Then at 3:30, we move on to question 2. Can we continue? Looking at question 2.1. On question 2.1, they give us that information. So on question 2.1.1, they say a trader, they give us that information, and then they say calculate the initial margin and indicate at what price there will be a margin call as well. So they ask us to calculate the initial margin and also indicate at what price there will be a margin call. So if you check on the information that they give us, they tell us that the trader buys 350 shares of the stock on a margin, and the price of the stock is 75 rand. The initial margin is 65%, and the maintenance margin is equals to 30%. So given this information, it would mean the initial margin is given as, the initial margin is going to be given as, they tell us that the price of the stock is equal to 75 rand. So they tell us that the price of the stock is equal to 75 rand. We are going to be having 350 shares. And then they tell us that the initial margin is basically going to be 65%. So the initial margin is going to be 65% of what we spend, what we're supposed to be spending on the stock, on the price, on the value of the stock. So the initial margin in this case is going to be equal to, so the initial margin is going to be equal to the price of the stock per share, which is 75 rand, multiplied by the number of shares times 0.65. Because remember, they say the initial margin should be 65%. So it would be 65% of what the value of the portfolio should be when you buy the portfolio. And in this case, how much do you get?
$17,550.
Mm,
17,062.50.
so it would be 17,062.50. So this would be the initial margin.
Okay, yes, but I'm still not getting 065. Does it matter?
Yeah, I would think that there's something that you would have done. Remember, it's 75 rand per share. It's 350 shares, and the margin is 65%.
2625 26,250. Because I'm getting 17,062.5. Either way.
Let me check 75 times 350 times 0.65.
17.62.
Yeah, it would be 17,062. So it should be 17,062.50. So it would be 17,062.50.
Sorry, Reynolds, I'm not getting, I get 1706.25. I'm not sure how we get to the 17,000. Do we times it by 100?
If you say 75
Oh, is it 350? Oh, sorry, it's 350.
times 350 times
It's 350.
0.65.
Okay. That's 350. Sorry, that's my error.
Okay. So on the second part of the question, they say indicate at what price, so indicate at what price there will be a margin call. So they also ask us to indicate at what price are we going to be receiving a margin call. So to see at what price we're going to be receiving a margin call, it would mean we are, so remember, they say a trader buys 350 shares of a stock on margin, and the price of the stock is 75 rand per share, isn't it? So which means in this case, we receive a margin call when we suffer a loss. So we receive a margin call when you suffer a loss. So which basically means that we receive a margin call when the amount in our margin account goes down by a certain amount, right? And if you check on the information that they give us, they tell us that the initial margin is equal to 65%, and the maintenance margin is equal to 30%. So which means if that is the case, it would mean we know that the initial margin should be equal to 17,062.50. So which would mean if our portfolio, or if the value, or if the price goes up by a certain amount, so if the price goes up by a certain amount, that's when we're going to be receiving a margin call. Because remember, you are holding shares, isn't it, right? So if you're holding shares, it basically means that you want to protect yourself from a decrease in price of your share portfolio. So you're holding shares and you want to protect yourself from a decrease in price of your share portfolio, right? So which basically means if your portfolio falls below a certain amount, that's when you are going to be receiving a margin call. So when your portfolio goes below a certain amount, that's when you're going to be receiving what? A margin call. So which basically means in this case, if your initial margin is given as 17,000, so if your initial margin is given as 17,062.50, so if your portfolio, if your initial margin is given as 17,062.50, we know that you will receive a margin call when the price goes down by a certain amount. So which basically means that if you say this plus, remember, we don't know at what price the price is going to go up by, minus the price where we are initially starting off at, multiplied by the number of shares. So it would basically means that when the portfolio, when the value of the portfolio is going up by a certain amount, that's when we're going to be receiving a margin call. Remember, on the trading portfolio side, or on the actual portfolio side, the value of the, we receive a margin call when the value of the portfolio goes up, because when the price of the security goes up, that's when the value of the portfolio is going to go up, right? So we receive a margin call from the initial margin if the value of the portfolio increases by a certain amount, and if the value of the increase by a certain amount, but at the same time, we are going to be receiving a margin call at a rate which is basically going to be less than the maintenance margin. Because remember, if the maintenance margin is going to be 30%, it basically means that at a certain price multiplied by 350 shares multiplied by the maintenance margin. So it basically means that when the value of the portfolio goes up by a certain amount, but at the same time, this will result in a situation where our portfolio overall is going to be less than the maintenance margin, the value that you're supposed to be getting on the maintenance margin. So this is the point where you're going to be receiving a margin call. So at a certain price X, when the value of the portfolio is going to be less than the maintenance margin, this is the point where we are going to be receiving a margin call. Because remember, here the price X is basically a price that we're saying is greater than 75, mainly because remember, here you're owning the shares. So if you're going to be owning the shares, you suffer a loss when the price of the share goes up. So when the price of the share goes up, that's when you suffer a loss, which also means that when you suffer a loss as well, it basically means that you are going to be receiving a margin call when the price of your shares go down by a certain amount. Because remember, if you look at the graph, we're basically saying this is the initial margin. And this is the maintenance margin. So we are saying from the initial margin, the share price can fluctuate over time, but the moment the share price or the moment your margin account falls below a certain amount, that's when you are going to be receiving a margin call. So the moment your margin account falls below a certain amount, that's when you're going to be receiving a margin call. And the margin call is going to ask you to top back the account back to the initial margin. Then you can now continue trading as well. So before we look at this particular equation, are we on the same page on exactly how it works with the margin account? Any questions? So when you buy your shares on margin, you are basically borrowing some of the money. So when you buy your shares on margin, you are basically borrowing money. So when you buy your shares on margin, you are borrowing money. So which basically means that if you start off at 17,062.50, which is at this level, when your margin account falls below a certain level, so which means this price X is basically the price which will result in a situation where your margin account falls below a certain level. So this level is where this price, which also results in a situation where this level would be less than what is supposed to be the maintenance margin. So now we need to find out exactly, so what is this price that results in a situation where from the initial margin point, if your portfolio goes down to a certain level, it will result in a situation where your margin account is going to be less than what? The maintenance margin. Because remember, at the maintenance, the moment your margin account goes below the maintenance margin, you're going to be receiving what? A margin call. So now we need to find out exactly at what price, which is price X, is going to result in a situation where the margin account, the value of your margin account is going to be less than the value that is required for the maintenance margin. So based on this, we're now going to try to solve for X. So based on this information, we can now be able and try to solve for X. So to solve for X, we're now going to say 17,062.50 plus X times 350 gives you 350X minus 75 times 350. How much do you get? 75 times 350. How much do you get?
26,250.
26.
26,250.
250 is less than 350 times 0.3. How much do you get?
103, 105.
105. So it will be 105x, isn't it? Remember, it's being multiplied by x then, right? Now, to solve for x, what are we going to do? We're going to group like terms together, isn't it? Take this 105 and bring it this side, and then take these amounts and bring them to this side. So which means in this case, it will be equal to 350x minus 105x should be less than 26,250 minus 17,062.5. So on the left hand side, 350 minus 105, how much do you get?
It's 245.
So 245x should be less than, and on the right hand side, how much do you get?
9,187.50.
9,187.50. Divide this side by 245 and this side by 245. How much do you get as the value of x?
37.5.
37.5.
Yes.
So if the price of the security goes down to 37 Rand 50, that's when we're going to be receiving a margin call. So if the price of the security goes down to 37 Rand 50, that's when we're going to be receiving a margin call. Because remember, our losses would have suffered exponential losses, and because of this, it means that we need to top up our account so that we're able to go back to the initial margin. Are we on the same page? So the main idea is that if you are going to be starting off at the initial margin, you receive a margin call when your portfolio has gone down to a level which is below a maintenance margin. That's when your broker gives you a margin call. So which means there is a certain price here which will result in the value of the portfolio being less than what should be the maintenance margin. So there's a certain price which results in a situation where the value of your margin account, so there's a certain price which is resulting in a situation where the value of your margin account is going to be less than the maintenance margin. So now we need to find out exactly, so at what price would you receive a margin call, which will result in, because your margin account is less than the maintenance margin. So in this case, if the share price goes down to 37 Rand 50, that's when you're going to be receiving a margin call. Are we together? Any questions?
Linus, where did you get the 26250?
Came from here, because remember we said 350 times x is 350x, 350 times 75, and we got 26,250.
Okay.
Reynolds, how do you calculate the x on a calculator?
You are not able to do that because you are solving for x. You are going to be solving for x, so you have to manually do the calculation. Are we on the same page? So the main
Reynolds,
idea is you receive a margin call when your margin account is less than your maintenance margin. So you receive a margin call when the value of your margin account is less than the margin call. So is less than the maintenance margin. So that's when you're going to be receiving a margin call. So we know that if you start off at the initial margin of this, there's a certain share price which will result in a situation where your margin account is going to be somewhere here. And this is a situation where this price will also result in a situation where it's going to be what? Less than your maintenance margin as well, right? So which means the value of your maintenance margin is going to be 350 shares times the 30% times the current value of that security as well. Are there any questions? Any questions? Can you move on? Please put your microphones on mute. Question 2.1.2. They say explain the difference between hedging and speculating from a trader's perspective. So they ask us to explain the difference between hedging and speculating from a trader's perspective. If you check in the textbook on page 118 of the textbook, if you check on page 118 of the textbook, they say instruments such as futures, forwards, swaps, options, and structured products are versatile. They can be used for hedging, for speculation, and for arbitrage. Hedging involves reducing risks. Speculation involves taking risks. And arbitrage involves attempting to lock in a profit by simultaneously trading in two or more markets. Excuse me. So it is this very versatility that causes problems. So sometimes traders who have a mandate of hedging risk or follow an arbitrage strategy become speculators. So the results can be disastrous. So remember we said, all in all, hedging involves reducing risks and speculation involves what? Taking risks. So here, if you look at it comprehensively, we would also say a trader is hedging when exposed to the price of an asset and takes a position in a derivative to offset the exposure. With speculation, the trader is betting on future movement. Yes?
I can see there's a lot of theory in this paper. So let's say in the exams, we still have the theory like this. Do we have to do the referencing or we have to write it in our own wording?
I would say that write it in your own wording to just show, because the moment you start copying and pasting, you might end up having issues. So remember we're saying speculation, with speculation, the trader is betting on future movements in price of the asset, hence no exposure to offset as well. So that's basically how you can be able to describe the differences between hedging and speculation. But remember, overall, we are basically saying that with hedging, the trader is basically seeking to reduce risks, and with speculation, it involves what? Taking more risk. Can you move on? On question 2.1.3, they give us that information. So they say, calculate the profit for both alternatives if the price increases to 210. So that's the first part of the question. Then they say, indicate which alternative is the investor should choose. Then they also say, how high does the stock price have to rise for the option strategy to be more profitable? So in this case, if the trader chooses the option strategy, so if the trader chooses the option strategy, the profit from the option strategy is given as the maximum of 0 or spot price at the end minus exercise price multiplied by the number of its core options in this case minus the initial investment. So what I've noticed is the common questions that I've seen so far are the ones that are regarding core options. Remember, it's not the only options that can also be traded. You can also be able to trade what? Put options, isn't it? So if it's a put option, so in this case, this is where you are going the core option strategy, where you look at the core option strategy. For the put option strategy, in case they try to make it difficult and then they give you the information regarding the put option, the profit would be given as the maximum of 0 or exercise price minus the spot price at expiration times the number of put option contracts or the number of put options minus initial investment. So far, we have been looking at scenarios where we were dealing with core options. The most common questions that I've seen so far are dealing with core options, but you can also look at trading what? Put options as well. Are we on the same page? So for the core option strategy, to determine the profit, remember they're saying, in this case, the price is going to end up being 210. So it's going to be the maximum of 0 or 210 minus the exercise price is given as 205. So the exercise price is given as 205 multiplied by the number of core options in this case is equals to 1,600 minus the initial investment, which is given as 20,000. $210 minus 205. 210 is greater than 205, so it's going to result in us exercising the option. So it's going to be 210 minus 205 that amount multiplied by 1.6 minus 20,000, and how much profit are you going to be able to earn?
Minus 12,000.
Minus?
12,000.
So in this case, it's going to be minus 12,000. So therefore, a loss of 12,000. Are we together?
Yes.
With the share purchase strategy, the profit is given as the spot price at the end minus the spot price at the beginning multiplied by the number of shares, which means the spot price at the end is 210. The spot price at the beginning, the current spot price is given as 200. And then they tell us, oh, this is, then they tell us that the number of shares is going to be equal to how many? 100 shares.
Good.
So given this information, how much profit are we looking at making?
1,000. 1,000.
1,000.
Mhm.
So if the share price ends up being 210, which strategy is better? Call option strategy or share purchase strategy? Which one is better?
The share purchase strategy with the gain.
The share purchase strategy, because it's the one that is resulting in a what? Gain,
Okay.
isn't it?
Mhm.
The next part of the question, they say, how does the stock, how high does the stock price have to rise for the option strategy to be more profitable? So to see how high the price has to raise for the option strategy to be more profitable, we first need to find out exactly what is the break-even price. The break-even price is the price where the core option strategy is equally profitable as the share purchase strategy. So this will give us the break-even price. So given that information, it would mean so they are equally profitable when the core option strategy has the same payoff as the share purchase strategy. And we know the payoff of the core option strategy is given as the maximum of 0, the spot price minus exercise price, times number of options minus initial investments should be giving the same payoff as the spot price at the end minus the spot price at the beginning times number of shares. So in this case, we're trying to find out exactly what is this spot price that will result on the left-hand side being equal to the right-hand side. So which means in this case, it's going to be, remember, if it's the same payoff, it basically means that you're expecting the spot price to be greater than what? The exercise price. So which means in this case, you're saying a certain spot price should be greater than the exercise price, which is currently given as 205, multiplied by the number of options, which is 1,600, minus the initial investment of 20,000, should be equal to spot price, which is what we don't know, minus the spot price at the beginning of 200. And we know we're dealing with 100 shares. So if we expand the bracket here, 1,600 times ST gives us 1,600 ST minus, because it's negative, 1,600 times 205, how much do we get? 1,600 times 205, because you're expanding this bracket to remove the bracket, how much do you get?
328,000.
So we get 328,000 minus 20,000 should be equal to 100 times ST gives us 100 ST, and 100 times 200, how much do you get?
2,000, 20,000, sorry.
So you'll be able to get a figure of 20,000, right? Now you need to group like terms together. And our ultimate aim is to solve for a positive what? ST, isn't it? So to solve for a positive value of ST, 1,600 is greater than 100 on the other side. So rather bring 100 this side, and then take the 20,000, bring it this side, take the 328,000 and bring it that side. And remember, if you move to the opposite side of the equal sign, if you're carrying a negative sign, you're going to be carrying a positive sign. And if you're carrying a positive sign, you will be carrying a negative sign. So if that is the case, it would mean, in this case, it's going to be 1,600 ST minus 100 ST should be equal to 328. When it goes this side, it's going to be positive. The 20,000, when it goes this side, is also going to be positive. And we're already sitting with a negative 20,000 here. So these two amounts are going to cancel out each other. And 1.6 times 100 gives us 1,500. ST is equals to 328,000. So since 1,500 is multiplying the ST there, we're going to divide this side by 1.5, and whatever we do on the left-hand side, we do it on the right-hand side as well. So in this case, what is the spot price where you break even?
218.67.
So it would be 218.67. So this is the spot price where the core option strategy and the share purchase strategy give you the same payoff. So which means the core option strategy is more profitable. So the core option strategy is more profitable when the price rises above 218.67 rand. So the core option strategy is more profitable when the price rises above 218.67 rand. Can you move on? Okay. Question 2.2, they give us that information. And then they say, explain to the trader what the impact will be on the short options in each of the following scenarios. In the scenario, they tell us that the stock price increases by 0.15 rand with no other changes. So the change in the stock price is going to affect our gamma and our delta. So the change in the stock price is going to affect our gamma and our delta as well. So if the change in the stock price affects our gamma and our delta, it would mean now we need to find out exactly. So what is the increase in the stock price of 0.15 rand, how is it going to end up affecting, explain to the trader what impact will be on the short options position in each of the following scenarios. So they're asking us to find the effect on the short option position in the scenarios where the stock price increases by 0.15, isn't it? So to answer your question, we would say explain to the trader what the impact will be on the short position, short option positions. So in this case, so in this case, we're only looking at the short position in the option, isn't it? So so we look at the effect. Do we need to demonstrate? But we still need to demonstrate the effect on the option so that we are able to see what the effect is on the number. If it's just going to be a single option, and how is it going to affect? How is it going to affect the option price? And how is it going to affect? Okay. Oh yeah. delta the effect of the delta is the delta 0.6. Look at the effect of the delta. Effect on option price. All the information to tell us that start off with the gamma, because the gamma estimates the delta, right? So when you get the gamma, you can say the effect on the gamma is in this case is 0.5, the delta is 0.6, which means in this case stock price for part A, of the question, stock price will have an increase of, if we check on the question, they give us that the delta is 0.6. So 0.6 times the price, which is given as the change in price of 0.15. So 0.6, when you look at the effect on the stock price, when you look at the effect on the option price, when you look at the effect of one option price, so when you look at the effect of option price, you're going to say is equal to, remember we're given that the delta is 0.6 and the stock price is gonna increase by 0.15. So what would be the effect on an option? So what would be the effect on the option?
Will be an increase of 9 cents, 0.09.
So it will be an increase of 0.09 increase, right? Because it's positive there, right? Because we know that the delta always moves in the same, it basically moves in the same direction as the movement of what? Of the security, of the underlying security. So the delta always moves in the same direction as the underlying security. So which means in this case, the option price is going to increase by 0.09, right? Then if it's an increase of 0.09 on the option, on one option, so it basically means that when it comes to 10,000 options, when it comes to 10,000,
Sorry, Rhinos.
Uh-huh.
Looking at the risk-free rate, is it not? I'm not sure if I'm not mistaken. It's 6%, but when we write it, it seems as if it's 60% when we say 0.6. I'm not sure, but when I check it, it's supposed to be 0.06.
Which one?
Correct me if I'm wrong. Where we said option price is equal to 0.6.
Uh-huh. No,
Is
no,
it
no,
not
no.
supposed to be?
Here, we are looking at the effect of delta. Remember, when you look at option Greeks, isn't it? The delta and the gamma are the ones which look at the effect on, which shows the effect on what? On the stock price. So whatever happens with the underlying security, the delta and the gamma are the ones who are going to be looking at the risk that you're going to be facing there. So the risk, because of the movement in the underlying security, the delta and the gamma are the ones that are going to be used to see exactly how much exposure you're going to be having. So the moment they say the stock price increases by 0.15 rand, it basically means now we need to find out exactly, so what happens to the effect of the delta and what happens to the effect of what? The gamma, because remember the gamma estimates the effect of the calculates the effect on the delta as well. Are we on the same page? So the 0.6 here is the delta. And if you check on the question, they say the delta of a single option is given as 0.6. And the price moved by 0.15 rand. So it basically means that you are also expecting the option price to increase by what? 0.09. Are we on the same page? Are we together then? All right. Then when you look at the short position on 10,000 options, so when it comes to the short position on 10,000 options, you're not going to say this 0.09 multiplied by 10,000. And how much do you end up with?
$900. 900.
So you end up with an amount of 900.
Yes.
So this 900, is it an increase or is it a decrease?
Is it times
For
1,000
the
or
party who took a
10,000?
short position? Sorry?
Is it 10,000 or 1,000?
Oh, it's supposed to be 10,000. Supposed to be 10,000.
No. Yeah.
It's supposed to be 10,000.
So it's a
So for the
decline.
party who took a short position, this movement of 900, is it an increase on their side or is it a decrease on their side?
It's a decrease on their side.
It's a decrease, isn't it? Because remember, the party who takes a long position. So for the party who takes a long position, right? So in this case, for the party who takes a long position, when they are gaining, the party who takes a long position, they're going to be what? Losing out. So it's going to be a decrease of 900 rand. Then now we need to find out exactly. So what happens with the delta of the single option and also what happens with the delta of the short position on what? 10,000 options as well. So remember, if you check, we say the gamma estimates the delta, isn't it? So the gamma estimates the delta. So which means the delta on a single option, the effect on the delta on a single option is going to be equal to, we know that if you check on the question, the gamma is given as 0.015, isn't it? The gamma is given as 0.015 multiplied by the change in the stock price is given as 0.15. So what happens with the delta of a single option? How much do you get? Zero point zero 0.015 times 0.15. How much do you get?
I'm getting 0.00225.
0.00225.
I think.
Remember, the gamma and the delta, they always move in the same direction, isn't it? So the gamma and the delta always moves in the same direction. So if they tell us that the stock price is going to be increasing by a certain amount, it would also mean that when it comes to the delta, we also expect the delta on the option to increase by a certain amount as well. So the delta of the option is going to be increasing. But now, when it comes to the short position on 10,000 options, you are now going to say this movement of 0.00225 multiplied by 10,000, how much do you get?
Uh, 22.
225.
How much?
225. 225.
22.5. Is it an increase or is it a decrease for the part who took a short position? It's a decrease, isn't it? Because when the part who took a long position is gaining, the part who took a short position is going to be losing out.
How do we know if it's a decrease, Rhinos?
Remember, we are saying when the party who takes a long position makes a gain, the party who takes the short position is the one who's underwriting that risk. So they suffer a loss. So which basically means that if the option price increases and we see that the delta of the option increases as well, it basically means that when it comes to the party who's taking a short position, they're expected to suffer a loss. So which means it's always going to be the opposite of that because they are the ones who are underwriting what? The risk. Are we on the same page?
Okay, thank you.
Okay. Next, we look at the scenario where we look at the effect of volatility. And if you check on the question, they tell us that volatility increases by 0.75% with no other changes. So we know that volatility is related to the vega, isn't it? So we know that the volatility is related to the vega, right? So which means if volatility is related to the vega, now we need to find out exactly, so what is the effect on a single option and what is the effect on what? 10,000 options as well. So based on this, we're going to say when it comes to the option price, the option price is going to be affected by, we are told that the vega is given as 0.402. So we're given that the vega is equal to 0.402 and the percentage change in volatility is 0.75, right? So it's going to be 0.402 times 0.75. So what is the increase? What is the effect in this case? Then
0.3015. It's an increase of 0.3015.
so it's an increase of 0.3015. Then, if it's going to be now on 10,000 options, if it's going to be on the short position on 10,000 options, the effect is going to be 0.03015 multiplied by 10,000. And how much do you get?
Trainers, is it 0.03015 or 0. It's supposed to be 0.3015 times 10,000, isn't it?
Yeah, times 10,000. Should be times 10,000 here.
Which gives us 3,000.
I said 0.402 times 0.75. Yeah, here it's supposed to be 0.3015. 0.3015 times 10,000.
It is 3,015.
So it'll be 3,015. Increase or decrease?
Decrease.
Decrease. Part C, we also look at the effect of, they say, if you check on the question, they say, one day goes by without any changes in the stock price or volatility. So we're looking at the change in time to maturity, isn't it? So here they say the theta per day is equal to minus 0.041. So if 1 day goes by, it basically means that if 1 day goes by, it basically means that for the option price, remember, the closer you are to maturity, the lesser the value of the option is. That's why you see that's given as negative, as the theta is given as negative there. Because the closer you are to maturity, the lesser the value of the option. So which means in this case, the theta is given as minus 0.041 multiplied by 1, right? So it's going to be minus 0.041 multiplied by 1. So what happens to the option price? It's going to be 0.041, which is a decrease, isn't it? Because remember, we're saying the closer you move towards maturity, the lesser the value of the option as well. So the closer you move to maturity, the lesser the value of the option. Then, when you now look at the short position on 10,000 options, so when you now look at the short position on 10,000 options, we are now going to say 0.041 multiplied by 10,000. And how much do you get?
Sorry, Rhino.
Yes?
Yes, Rhino, I just want to check something. You just mentioned that the closer you move to the maturity, the lesser the option price. So with regards to the first two option price that you calculated, what's happening? Because I see you have increase.
No. Remember, these ones have got, remember the time to maturity is affected by the theta, isn't it? So part A and part B, it's separate from part C, because part C, you are looking at the effect of theta, right?
Okay.
Yeah, you're looking at the effect of theta. And we say the closer you are to maturity, the lesser the value of the option. So that's why you see that the option price, when we move forward one day, the option price is expected to go down. Why? Because the closer you are to maturity, the lesser the value of the option.
All right, thank you. Thank you.
So don't assess part A, the effects of the change in the stock price, it's independent on its own. The effect of the change in volatility is different on its own. And the effect of change of what? Theta is also going to be different on its own as well. Because it's going to be affecting different components of what? Of the portfolio anyways.
All right, thank you.
Okay. So 0.041 times 10,000, how much do you get?
So 410.
410. Is it a decrease or increase?
An increase.
It's an increase, isn't it? Reason being, for the party who's taking a long position, the closer they are to maturity, the lesser the value of their option, isn't it? And the lesser the value of their option, the more beneficial it is to the underwriter, who's the party who's taking what? A short position. So the closer the contract goes towards maturity, the more it is beneficial to the underwriter, because they know that if it ends up in the, if the contract ends up out of the money, they make a gain, isn't it? So it's always going to be the opposite of what's happening with the option price. Are we on the same page?
Yes, but tell me, Rhinos, on the option price, there was that minus sign, minus 0.041 multiplied by 1. Where is that minus went to? That minus sign?
This one?
Yes.
It's here because I'm indicating that it's a decrease.
Or you don't put it when you go to the
You don't have to worry about the sign there because it's already indicating that it's a decrease. We know that it's going to be a decrease in this case for the option price. So the minus sign is just there. Remember they say the theta is minus 0.041. The reason why they're giving you the theta as a negative amount is mainly because they are acknowledging that the closer you are to maturity, to expiration, basically, the closer you are to expiration of the contract, the lesser variable the option is going to be. So the lower the option price anyways. So in this case, that's why I'm saying that it's going to be a decrease of 0.041 because we know that's why the theta is coming out as much is being given as negative because it's acknowledging that it's going to be a decrease. Are we on the same page? Any questions?
Sorry, Rhinos, when calculating that short position, why are we not using minus 0.041 times 10,000?
Okay, I'm gonna prove this mathematically. Negative. It ends up being confusing. Different movements of science. Probably you would have indicated here that the amount is negative, but then if it's negative like this, you now need to go further and indicate that it's a decrease of 0.041 decrease. If you do the calculation there, and if it's negative there, do we put it? Do we know that? So because we know that the part who take a short position is going to be facing a commitment, do we put these amounts, whatever is happening in the short position, so minus, yeah, minus. I'm very wary of trying to put the first one, put it as negative. Because here you can also put this amount as a negative amount. Then it will come out as a negative amount, but you need to indicate that you can put this amount as negative and it will come out as a negative. But if you do it this way, you will need to go further and indicate that this 410, although it's negative, is actually an increase. So if you put the amounts as negative and you confirm the signs there, you will need to go further and indicate that whether it's an increase or a decrease, which means that in this case, if you say minus 0.041 times 1 and you get minus 0.041, right? Then you need to go further and say, so therefore it's a decrease of 0.041. Then here, when you're looking at the short position on 10,000 options, if you say minus 0.041 times 10,000, you get minus 410. You will still need to indicate that it's therefore it's an increase of 410 as well, because we know that when the party who takes a short or long position suffers a loss, the party who takes a long position is going to end up suffering what? Having a gain as well. Are we on the same page? Are we together?
Yes. One last question, Rhino. My confusion is still on the increase and decrease part. Can you just clarify for the last time, or maturity? When you talk about maturity, where do I look at in terms of identifying what the maturity part? That's where I don't get it.
Now, where the maturity part comes in, if you check on the question, right? If you check on the question, they tell us that, so if you check on the question, they tell us that, so if you check on the question, they say 1 day goes by without changes in the stock price or volatility. Are we on the same page? So which means, remember here they say, and time to exercise of 25 weeks, isn't it? So which means if 1 day goes by, we're basically saying, if you look at your timeline, you are starting off on day 0. The contract expires in 25 weeks. So if you move forward 1 day, isn't it? If you move forward, you have basically moved forward 1 day, isn't it? And what the idea is to know exactly what is the principle behind the effect of these Greeks as well. So the idea is, the closer you are to maturity, the lesser valuable the option is going to be, whether it's a call option or whether it's a put option. So the closer you are to maturity, the lesser valuable the option would be as well. So if you move forward by 1 day, now you want to find out exactly, so what is the effect on the option price? So we see that minus 0.041 is going to be the theta, and they've moved forward 1 day. It basically means that because it's negative, we are already acknowledging that it's going to end up having a situation where the option price is going to be going down by how much? By 0.041. So do you see that if you check on the question, if you look at the Greeks there, do you see that when you look at the Greeks, when you look at the delta, when you look at the gamma, when you look at the vega there, right? Even when you look at the rho as well, do you see that the theta is the only one which is giving you a negative amount, or which is given as the negative amount? Mainly because they are acknowledging that the value of an option decreases the closer you are to maturity. So if you've moved forward by 1 day, it means you are going to expect the option to actually what? Go down. That's why you see that when you look at the option price, the theta is already given as negative, because they are acknowledging already that the option price is expected to go down. And by how much is it going to go down by? If you move forward 1 day, it's going to go down by 0.041. But now, if it goes down by 0.041, what happens to the party or to the counterparty who's taken what? A short position? To the party who has taken a short position, it's going to be a gain to them, isn't it? Because the closer it is to maturity, the lesser the chance of them having what? An obligation of paying the party, the counterparty as well. So if it's a gain for them of 0.041 per option, it means on 10,000 option is going to be a gain for them of what? 410. So that's basically the idea behind it. Are we on the same page?
Yes, thank you.
Okay. Are there any other questions?
Renos, this is the first time I've seen them asking these questions like this. It was quite confusing when I looked at it.
Which ones?
This question 2.21, I found it quite confusing because normally they don't ask it like this. I don't know, I found it very confusing.
Yeah, but remember, this question also came out in the assignments as well, right? So this question also came out in the assignment, and we don't know the trend as yet on how they would love to ask or how they like to ask these questions, because so far only 2 exams have been written officially for this module. As a side note as well, there are those who are asking me for past papers for the other years. Please take note that the only past papers which are relevant is the 2021 past papers. And for 2020, the only material that is relevant is the assignments, which I've already linked as well.
And I think the similar question was also asked on the Jan Feb 2021.
Okay, I can't remember.
Yeah, it was on, I think it was also 2.2.
Okay.
Yeah.
Can we end here today? Please note, I might announce an adjustment to your timetable. So I might announce an adjustment to a timetable where we are going to be having a day during the week where we're going to be meeting as well. I'll tell you exactly which day on top of the ones that have been scheduled already. So that at least when we meet that on that day, we're able to finish off question 2 and look at part of question 3. Then when you know that we're not done with that, in the next class that is officially given on the 22nd, we'll be finishing off chapter 3 and going to chapter 4, and we'll be finishing off question 3, going on to question 4 as well. So I'm going to slot another day during the week. I'll announce to you guys tomorrow where we need to finish question 2 and also go on to question 3 as well. So that by the 22nd, we're done with the paper. Then after that, we just look at practice questions as well. But please make sure that you also look at the practice questions that we did with the previous stream as well. The questions that are there, the videos are there as well, and the memos are there as well. So please have a look at them. And also 2020 assignments, the videos, the relevant assignments, for the relevant assignments, the videos are there, the questions are there, and the memos are there as well. They are given there. I think I shared the official memos with the lecturers as well for those questions.
So we must look at the assignments for 2020 on the portal. It's got the questions and the answers.
They are there. They're assigned for the assignments. The questions are there. For 2020, the questions are there. The videos going through the relevant assignments are there as well.
So you say you must look at the assignment. What was the other thing that you must look at other than the assignments?
With the previous stream, we did also look at practice questions because they didn't have past paper or past exam papers as well. So we did look at practice questions. I think it was we did practice questions 1, 2, and then I think practice question 3 or question 4 was a quiz as well. I think we did officially practice questions 1, 2, and 3, and the 4th one was a quiz, which is also made available to you guys. It's there on your portal.
Thanks.
All right, please have a look at them.
Okay, thanks.
Are there any other questions? Are there any other questions?
Okay.
All right. Enjoy your Sunday and your week.
Thank you.
Thanks, Linus.